Hello, welcome to Any Answers Answered for December 2023. Tax returns just round the corner, but just enough time for Tim and for me to have a look through the pages of Any Answers and find a couple more questions to have a look at. Our first question, Tim, comes from Duncan Phipps Tate, and the question is an essay, so I'm going to actually ask you a question based around it rather than the question itself. But let's start with the technical point. If I'm entitled to receive a pension and I decide to defer that for a period of time, certain people are entitled to do that, and let's say my income is £50,000 a year, I then receive my lump sum entitlement some years later, and I'm going to receive millions of pounds as my lump sum, but because I'm only up to £50,000 and therefore paying 20% tax, I actually pay 20% tax on the whole of the lump sum.
Yeah, let me first say that there is a dwindling band of taxpayers for whom this is relevant. And those taxpayers will be anybody who reached state pension age before 6th of April 2016, which was when George Osborne replaced the basic state pension with a single-tier state pension. Sadly, I am not one of those taxpayers. I'm just too young. And I say sadly, because if you did reach state pension age before April 16, you could choose to defer taking your state pension. And then at a later date, when you do decide to take it, you can get a lump sum. So you can defer it for a lump sum. Now, those of us that reach state pension age on or after 6 April 16 can defer, but only to get an increased annual pension paid monthly when we decide to start taking it. So I wasn't able to defer mine in return for a lump sum. That's the first point. Although, as part of that, I should say that if you were aged, let's say, 72, and so you were born, you were of state pension age before April 16, then you might have been claiming your state pension, so having it paid, but you could now, today, at the age of 72, say, I want to defer it for a lump sum. So it is still open to some in their 70s to defer for a lump sum, is the fundamental background to this. But most of us, we can't defer, so we're not going to be interested in this, or we can defer, but only for an increased income, not for a lump sum. But then the second point is that when you do decide to cash in and get that lump sum, assuming you haven't lost it in the meantime by dying, and that's an important point, when you do take it, the tax rules are a little bit unusual because tax on that pension lump sum is levied at the rate that applies. This is simple, but basically is how it works, at the rate that applies to your other income. So if, as in your example, you're a basic rate taxpayer because you've got other income, but no more, and you receive, let's say, a £45,000 lump sum. In fact, the poser of the question here, I think, suggested that the taxpayer had 30,000 of other income or of income in the year, and then was thinking of cashing in 45,000 of state pension lump sum. And the good news there is that you don't add that lump sum to your other income. Instead, you would tax it at the rate applicable to your other income, which would be that 20%.
So having confirmed that the average tax rate is 20% for this guy, Duncan then comes up with the second question, or the key to this particular point. Is there any way he could now reduce his tax liability so that the total is not taxed all at 20%, but is all taxed at 0%? And the way he wants to do this is to make a pension contribution against his other income to pull him down below the personal allowance.
Well, before directly answering that, it clearly is the case that if you were able to reduce your 30,000 of income down to 12,570, so that you're a 0% taxpayer, perhaps by some sort of loss that you managed to come up with, then yes, you'd be 0% on the whole of the state pension lump sum. But the question that the questioner asks, as you say, is could you in fact pay a contribution into a personal pension of, let's say, 30,000 to get your income down to zero. And that would then eliminate could be £9,000 on the sort of pension lump sum that we're talking about in the example. I'm afraid the answer is no. And the reason why the answer is no is because the payment of a contribution into your private pension, in fact, extends your basic rate band rather than acts as a relief against your income. And the way in which the tax charge on the pension lump sum is calculated is not quite as straightforward as just saying it's your average tax rate. It would extend your basic rate band, but of course you're still being taxed at 20% on that 30,000, but with an extended basic rate band from the pension contribution. So it wouldn't work. And I'm afraid that really is the end of that.
A very good tip. Our second question this month comes from Wisco Wills. And Wisco Wills wants to know, in this situation, Mr. X owns company, the first company, 100%, and it's a trading company, and Mr. X is the sole director. But Mr. and Mrs. X, so his wife now involved, own another company exactly 50-50, an investment company with commercial property. Mr. and Mrs. X have a role managing the company. I mean, let's cut to the chase, Tim. Very simply, are they associated?
Well, it is a very important question given the reintroduction of differential tax rates and the need to identify associated companies for dividing the thresholds for the higher rate of corporation tax. Now, let me address the circumstance. You've got a husband's company solely owned and managed by him, and then you've got the jointly owned property investment company, husband and wife. Before we address the substantial commercial interdependence question, let's just ask two questions. A, who is the chairman, if there is one, of the property investment company? And B, what loan finance, if any, has been provided to the property investment company? Because if, let's say, the husband is the chairman and has the casting vote, then the two companies would be associated as being under common control without the attribution of the wife's shares to the husband. Secondly, if the husband has financed the property investment company to a greater extent than his wife, then on a winding up of that company, his entitlement to the net assets would be higher than hers. And that again would mean that the company is associated with his consultancy company without having to attribute her rights to him. And so there is a possibility that they're associated without even the attribution of rights. And it is only when the association can be established only by attributing rights that we then turn to the question of whether there is substantial commercial interdependence. Now, turning to that question, I would suggest that we have a look at the HMRC Corporation Tax Manual, and we start at CTM paragraph 03770. And that's the page in the Corporation Tax Manual that looks at the rules for establishing substantial commercial interdependence by virtue of the companies being organizationally interdependent. And the revenue say that two companies are organizationally interdependent if, in particular, the businesses of the companies have or use common management, common employees, common premises, common equipment. And they give as their first example, husband and wife each run their separate companies from their family home, owned by her. His company couldn't afford to buy or rent other accommodation to trade from. So his company is being run in the family home. And apart from sharing the family home and the family's domestic phone line, there are no other financial, economic, or organizational links. Although his company couldn't survive organizationally or financially without use of the family home, there's no direct or indirect financial support from either his wife or his wife's company to either him or his company, and no organizational links which amount to substantial interdependence. And I think that's quite a helpful example in the circumstances that are included in this any answers question.
So potentially a situation where you might be able to help out, but an awful lot of pieces of paper to consider and look at and work through to decide what the right answer would be. That's all for this month. Do join us not next month because we leave you to your January tax returns, but the month after. We will see you in February. Until then, bye-bye for now.